This video is an introduction to the validation of stock. So the first obvious question is, what is stock validation? So stock validation is the process of counting the stock to confirm that it exists as an asset to the business. In the perpetual stock system, the stock is validated by comparing the book value in the trading stock account to the physical stock taking at the end of a period. The trading stock deficit is then calculated as follows in formula form. It is simply the trading stock account closing balance minus the value of the physical stock account, or the physical stock count rather, not stock account. In the perpetual stock system, it is very difficult to validate stock because there is no amount to compare with the closing stock value, as we only know the value once we do the stock taking. The only way that we can validate the stock is to calculate the profit markup that we actually achieve and compare it with the intended profit markup. This is a process we will look into later. Now, there are three ways in which a business can value their stock through cost calculations. The first is the specific identification method. The cost price of each item that is sold is specifically identified as it appeared on the purchase invoice. So this method is usually used in a business that sells items that are easily identifiable, like vehicles or jewelry. You need now to consider that these validations has to do with the fact that we could purchase stock throughout a period of time at various prices. And now when we sell the stock, we need to determine the cost price. Also, when we have to value the stock at the end of the financial period, the stock that remaining, we need to attach a value to those. And now since we have a mixture of different prices when bought at different times, that's why we have at least three different ways that we can value the stock. So the specific identification method, it's like we know basically the item that we sell, what that specific item's price was when it was purchased. That's why I tend to use for items that are large and of huge value and that we tend not to sell very often, like on a daily basis. In terms of consumers. So the same consumer will, for example, not buy a car on a daily basis. So it's for the fairly low turnover items that we use it. So then we also have what we refer to as the first in, first out, or FIFO method. This method is now based on the assumption that stock that is bought first will be sold first. So the cola that we bought first is the one that we will sell first, because now we can imagine Coca-Colas, you are going to sell many of them in a day too. So it's like a high turnover rate. Consumers will tend to buy it maybe even on a daily basis. So it will be very difficult to identify, just due to the large volume of Coca-Colas that you bought, which specific price is the one that you sell at when you actually bought it. So the specific identification method is not going to work well here. So yeah, the assumption here is the first one out is the first one in fact is the first one out. So the price we bought the first ones, that will be the cost price when we sell that one first. Whereas what will be left in our stock will be the ones that we purchased last. That price will be used to determine the value of our stock at the end of the financial year. Another method that we could use is the weighted average. So here, a weighted average cost is calculated based on the available stock on hand. So the formula for this is to take the total value of the units available to be sold and divide it by the number of units available to be sold. So in fact, we just take all the purchase prices throughout the financial period, add them all together to get the value of them, and then divide that total by the number of units that we purchase throughout that period to get the average cost. So therefore, the average cost will then be used both as the cost of sales value when we sell something, as well as for those items that we did not sell that remain in stock to value that at the end of the financial year.